Hi guys, my name is Samuel. Sammy FX is my trading channel, and today I'll be showing you guys how to trade forex and as a beginner and the right way to go about it. So if you're new to my channel, like, comment, subscribe, and leave a comment so that the YouTube algorithm can push the content forward. So basically, before you start trading forex, you need to understand something. Forex means um, foreign exchange, which is where you're buying and selling currencies and you're banking on the different fluctuations that happen. Maybe today's price is like, for instance, I'm making this video from Nigeria. So let's say, for instance, I want to buy USD, and today the USD sells for one USD sells for around, I think, 1,500 naira, or so around that range. Now, if for instance tomorrow it gets up to 1.8 and I sell what I bought today, that means I've made an extra 300 naira. And if tomorrow it loses value to 1,200, and I try to sell tomorrow, that means I've lost $300. So that is what the forex market is. So it's just basically buying and selling currency pairs with the hope of making profits. Now, before you begin, you need to know a few things. For you to trade successfully in the forex market, you need to have a source of income, maybe save up money from your day job or whatever allowance that you've been getting. So you need to save to fund your account. If you're going to start with, let's say, $100 account, you need to get that $100 from another source that you've already made money from. Now, when you fund your account, you will notice something as you go along. You will notice that with a small account size, and by small account size I mean like maybe $100, you will not be able to practice good risk management. So what do I mean by that? In risk management, you should be risking no more than 1% of your account size. So for $100 account and you're trying to risk 1%, that means you're not supposed to lose more than $1 in your account per trade. You understand, for good risk management. And then your profit too, maybe if you're doing a 1:3 profit, your profit should be like maximum of $3. But what happens is, a lot of times people want to trade $100 account and they want to make $1,000 profit. Is it possible? Yes, it's very possible. A lot of people have done it. People have moved $100 to $10,000 and above. But as a beginner trader, you need to understand how the forex market works first. You need to follow good risk management, because if you don't follow good risk management, you end up losing accounts. And losing accounts is not entirely bad in forex, but it's part of the learning curve. You have to lose accounts at times. But um if you really want to follow the risk management part of things, then you now find out that you need a larger account size. So thankfully, now we have pro firms. Pro firms are proprietor firms. There are firms that give you their capital to trade, and when you trade it, you get to split the profit with them. If you follow my channel, I promise to be giving you more videos that eventually will get to that point where we'll talk about pro firms and how to benefit from it. But ideally, a pro firm will give you, for instance, $100,000, $10,000, but you have to pay first for it. So you might be required to pay, like, let's say $176 or so. That's for FTMO. When you pay $176, they'll give you a $10,000 account. And then when they give you a $10,000 account, you are required to make 10% profit to pass the stage one of the challenge, and then 5% profit. On the other side, if you lose 5% daily, if you exceed 5% loss daily, or if you lose 10% of the account, you've lost the account. So those are like the pros and cons of the forex prop firm approach. But you see that you will now find out that it's easier to practice good risk management with a bigger account size. So you can now implement your 1% loss. So for instance, on a $10,000 profit account, you're not going to be exceeding 0.1 um, lot size. I will explain what all those things mean. So that means per trade you're risking like $100 and you'll be targeting for like $300 here. So yeah, that's the first things you should know. Then let's move into what Forex is. So I'll switch over to my screen now. Let's take a pair for instance. So we have this pair now. We have this pair. Let me start with this GBP. So the interface I'm analyzing my pairs on is called TradingView, tradingview.com, and this is actually my own analysis that I've already done. So let me see if there's let me see if there's a particular pair that I've not analyzed before. So I'll use this for this thing. Anyway, it doesn't really matter. Let's just use this one. So on the right hand side, you see the values. So you're actually trading NZD which is New Zealand dollar, Japanese yen. These are the time frames. You can go to the 1 month, you can go to the monthly time frame. Yeah. On this other side are the price points. Then these are like the timelines. So the most important things you need to know is how to calculate this, because if a pair move from, let's say it moves from 9, let me drop down to a smaller time frame so it's easier to understand. Let's say a pair moves from 96 now. So here this particular point is around 96, 96 on the dot. So let's say it moves from 96 up to this 97. That means it has moved 100 pips. Yeah, so that's one of the things you need to know. And then for 100 pips movements and a lot size, there's what they call lot size. So if you're going to place this trade, you need to have what they call lot size. So you place a trade according to lot sizes, but your lot size multiplied by the pips will give you uh, sorry will give you a representation of the amount. So let me, if I can quickly Google lot size. This initial parts are things that you can actually learn on your own. Let me see if I can just use an image to explain this part. Yeah, exactly. So we have what they call a standard lot, or mini lot, micro lot, and nano lot. So if you trade, most brokers will not go below the micro lot, which is 0.01. So on 0.01, it represents 1,000 units. But these are things that you understand later. You understand? So when you place a trade with 0.01 and it moves 100 pips, you've made $10. That's just what I wanted to explain. So maybe later we'll get to understand more calculation. So if I place a trade with a mini lot or 0.10 and the trade moves 100 pips, that means I've made $1,000. Yeah, 0. Sorry, 0.01 and it moves $100. Yeah, I've made 10. It moves 100 pips, I've made $10. Now 0.10 and it moves 100 pips, that means I've made $100. Then one standard lot size and it moves 100 pips, that means I've made $1,000. So that's like calculation, which we'll be able to explain later. So we use this as the basis for how we calculate our amounts. Listen. So yeah, we So let me go back to the pen. So later I can still give more videos on that. Or if you don't understand in the comment section, you can ask for more clarification. Now the next thing we need to know is for you to actively start trading, you need to sign up with a broker, and then most trading on Forex, most of the trading on Forex is done on MetaTrader. So it could be MetaTrader 4 or MetaTrader 5. So but MetaTrader, yeah, this like what it looks like on your, it's an app for mobile phone. This is what it looks like. Then on the desktop, this is what it looks like. So yeah, that's what the MetaTrader looks like. Now if we go back to our charts, let us understand how these trades actually happen. So we will now move to what they call technical analysis. In technical analysis, you're supposed to understand when to place a trade, how to even understand what is going on in the market. Yeah. So you must understand a lot of things before you start trading. So let me look for a pair. Let me look for a pair that I've not analyzed before. So that it would be like a plain pair. Yeah, a blank pair. Mm, what's happening? I want to look for a blank pair. So let me look for. I think it has added. Yeah, that has been added to mine. So now, before you start trading, you need to understand a few things. So the market will move. So I've switched to my monthly now. Please, this is one of the what I'm about to show you now is one of the most important concepts of a forex market. So please pay attention. I'm just trying to size this properly so that. So let's start from. If you look at this crosshair here, we are around I think June, Friday, 1st June 2012. Yeah, we can start our analysis from there. Now I'm going to take this rectangle. I'll draw out a couple of I'll draw out a couple of let's say graphics, then I'll explain. So I just clone this. So what am I looking for by doing this? I'm looking at what is the concept of support and resistance, which is like the first and the most important aspect of is like the most important aspect of technical analysis. So what is a support? A support is a place that the market fails to break easily. So as you can see, come let me arrange this thing well. So as you can see, there is a huge downtrend here. I've not explained the concept of trends, but I'll explain that shortly. So you see that this price has fallen down to this point, and it failed to break here. So we put this as a monthly support because the market reversed from this point and it started going up, making an uptrend. Now, if you look at this particular place here, you can see that it got up to this point and fell back down. So this is called a resistance. So the places that the market failed to break to the upside is called a resistance. So we have a resistance touch point here, resistance touch point here, here, and somewhere here. The next concept that we need to understand is the concept of trends. Now, when a market, let me quickly do something. Okay, so I think let me use the brush tool. So if a market is moving downward like this, if it's moving downward, forgive my horrendous graphics. That is called a downtrend. That means the market is trending downward, and it's usually called a bear market. Now, if it is moving upward in this direction, you can see it's called an uptrend. It's called an uptrend. Then, if it moves in such a way that it's moving sideways, it's called a ranging market. That means there's no clear direction whether it's up or down. So let me quickly drop down to the weekly time frame to explain another concept. And this other concept too is very, very important. It's very, very important that we understand these concepts as beginner traders because these are like the fundamentals of becoming a good trader. And if you miss this kind of lessons or this kind of initial this thing, you find trading quite difficult and it will look like gambling to you because you really don't know what is going on in the market. So remember I said if a market is moving here this way, it's called an uptrend. If it's moving sideways, you see the sideways pattern here is ranging. Yeah, it's ranging. Now, but there is another concept that we need to understand. A market that is sorry. Um, Now, a market that is moving in an uptrend, it doesn't just go up in a straight line. It makes it makes a kind of you see, this is what they call a higher high and a higher low. So it has made a high, but it will retrace a bit to make a low. Then it will push, then come back down to make a lower before pushing. Now, if you look at what I just, let me see if I can zoom in a bit. If you notice these lines, it is actually making a higher high. This is a high, this is a low, this is a low, this is a higher high. Now, if you connect all of the lows using a trend line, that's for an uptrend, you find out that you can actually, guys, forgive my black color. Maybe in subsequent lessons, I'll try and switch the colors out so that everything becomes easier for people to see. But for now, this is how I kind of lay out my charts, and I really don't want to lose the layouts just because I want to do this tutorial, so please forgive me. But if you look at this trend line, this is the trend line here. This one I'm pulling out is connecting all of the lows. Now, if I come here and I clone it and I make that same line to connect all of the highs, we have now formed what they call a trend channel. You see these two lines now, this and this. This has formed what they call a trend channel. And if you look at the way the market has moved, it has moved within this channel. So it touches the top side, touches the bottom one, touches the upper one, touches the bottom one, and continues. So now that is the concept of a trend channel. These concepts are very, very important in trading. They are very, very important. So what we've done now is showing us an uptrending channel. So let me look for a downtrending one so that I can actually use this. So now if we repeat the same thing for a downtrend, we connect all of the bottoms, then we clone it, connect all of the tops, we are going to get a downward channel. And what's the significance of a channel? So you see these things can be repeated. Uh, Sometimes it might not be as perfect as you want, but just know that in drawing of these channels, try and connect at least the most touches represents a very valid channel. So the lines or the trend lines that have the most touches will represent the best set of lines for your trend line rather. So it's not sometimes it will not be perfect. Remember, if everything is easy, everybody will be doing it. So that's why the forex is not as easy as many people think, because as you can see, the market is actually roughly respecting this one, but see, this one did not actually get to the top and just decided to come down. So these are like the things we look out for in the market before we make trading decisions. Just a recap, I've given you the concept of support and resistance. This is a resistance. This is a support. The market is failing to break below this, so it becomes a support. The market is failing to break above this, so it becomes a resistance. Now, the significance of the channels, of the trend channels. So if you notice, this market has moved from let's say one 1.5296 abruptly down to 1.4339. Now, if you remember our initial calculation, a market that moves from this point, which is 296, down to this point, which is 383, has fallen about, let's say, roughly 100 pips. Sorry. Oh no, it's more than 100 pips. So from here, 1.5. So this is 100 pips. In fact, I think it's almost 1,000 pips from here, because remember this is a weekly. So 1.52818. So somewhere here, this is 200 pips, 300, 400, 500, 600, 700, 800, 900. So about 900 pips. This market has fallen here. So this presents a trading opportunity that for an uptrend, every time it touches this bottom, we can actually buy, and our buy positions, normally called long, we can we can set this kind of trade, so something below this or outside of the channel, and we target the next high. So this is a risk to reward of 4.72, and giving us uh amount of 2,179 pips. So you see this kind of trades on the weekly is quite massive, but remember there's also a risk, and the risk is this part of it. So if you lose out on this part, you're going to be losing 750 pips. So yeah, am I correct with my calculations? Let me see. 376 down. No, this is going to be around 300 pips or so. But you get the idea. So we this is how we trade, right? This is how we trade. Then one important factor, or one thing that we need to know is, from the bottom here, if you're trading if you're trading an up channel, an uptrending channel, you must make sure that you're doing more of the buys than sells. So if you're trying to hit a sell on this kind of market, it is called counter trending, and the dominant direction of this trade is actually in a bullish way. So that means most of the trade that you should be taking are longs, because everybody's buying, so there's no reason for it to sell. Now we have basically covered everything that has to do with trading. But another thing we need to know is, don't enter trades on the weekly time frame, because it represents a whole lot of risk, and it's just too huge for you to be trading like that, especially if you don't have a very big account size. So for day traders, for day traders, what we normally do, is to make sure that our pairs we enter in like 4 hour, 1 hour, depending on our account size. Yeah, depending on our account size. Yeah, the chart is quite messy. Forgive us. So depending on the account size, we can enter on a 4 hour, so that we can now make our stop loss to be smaller. You understand? So imagine the market was around here. We can actually take this and it becomes a valid trade. Now remember, trading requires a lot of patience. What do I mean by that? These things don't just move in one day. You understand? So each of these candle, they call it candlestick. Oh, and I didn't even talk about the concept of candlestick. I'll quickly open it up to show you what the candlestick is. But every time the market opens and closes one of these bars, it represents 4 hours. You see, it represent this is 4 hours, 8 hours, 12, 16, like that. So that means you probably, if you had entered this trade from somewhere here, this was on Tuesday, 30th August 2022, and you're expecting it, you wanted it to get to the top of the channel. It actually got to the top of the channel on October. So that's like August to October. So you see that August, September, October. So that's like 2 months. So we really don't trade and hold trade for 2 months. So what we normally do is to still drop down to the 1 hour, and sometimes you just take a smaller portion of the trade instead of waiting for the entire move. So yeah, sorry, I need to, let me just go back to the daily so that it will be clearer for us to see. So we can actually take these trades. There is nothing wrong with it, but if you will notice that the support and resistances that we did for was for a monthly. So we can actually drill down further and do a kind of daily support and resistance. So you see that now we can now break this huge swing. Um, we can now break this huge swing. We can now break this huge swing into smaller bits. Yeah. Because the more we drop it down, we can see other smaller structures, the market structure. So you can see that the markets failed to break this part, and then this was the kind of support initially. So yeah, the chart is kind of messy. So yeah, that is how you do your that's how you do your technical analysis for trading. So you see that every time the market touches this channel, which is coming from a higher time frame, you can actually take a buy. So somewhere here, you can actually take a buy, and then you target the next structure. You can just target the next structure. Let's say, for instance, you targeted this other high. So this is a risk to reward ratio of 4.85. Remember that from here, from the stop loss position 978 to 825, that's roughly 30 plus about 80, let's say 100 pips, yeah, as your stop loss. So what does this mean? If I had let's say trade with 0.01, so this will be representing $10, and I'll be gunning for 981 to somewhere is about roughly 671. So that's about 800 pips. So thereabouts. Yeah. 100, 140 pips or so. But these are the calculations that we can easily get from just learning about how to make all this calculation. And there's a website that you can learn how to just make all of this calculation, and it's called babypips.com. In fact, I feel like every trader should go through this platform first before before trading. So yeah, if you click on start learning, they will give you the fundamentals of how to calculate pips and all of that. So yeah, this is where you can just learn all of those calculations from. So I think we've come to the end of this video. The next series we'll be talking about risk management, trading psychology, and everybody can. One of the things that people don't know about trading is almost everybody can read all of these charts, especially when you're not in the live market. It's really easy for you to say, oh, I'll do this, I'll do that. But in a live condition, you see, for instance, this market pulled back. A lot of people would have panicked, oh, it's about to hit my stop loss, and then to close the trade. So it's actually in live trading condition that a lot of decision making we differentiate the different kind of traders. So you can look at a market that has already played out, and you be like, oh, okay, it's easy, it's easy, it's easy. It's just to place, it's just to place a buy here. Oh, why is my system hanging a bit? You say, oh, it's easy, it's easy. It's just to place a buy here. Then you target this top, these highs. But initially, if you see a retracement here, you be like, oh, maybe this is the top, and you close your trade, or you'll be scared. So that all those emotions that come with trading the live market is actually what makes people to be better traders, or not really bad traders, but you understand what I mean. So yeah, this is where we'll be stopping for today. There are other techniques that actually helps you, that enhances your trade. For instance, if you're putting a stop loss here and the market moves to this point, you can actually move your stop loss again. You understand? That's what they call trailing, stop loss trailing. Yeah, but with other videos that I will release to this my channel, Sami FX, I'll be touching on other advanced techniques. So yeah, please don't forget to like if you're enjoying this content, please. So I'll just walk you through a few of my pairs that I've already done technical analysis for. So you see that these are like live markups, and you see how the market violates it sometimes and changes and moves us out of it. So, and then you see a stop loss hunt. A lot of things happens in the live market. So you just have to see, like now, from what I told you guys, we had a channel. This is supposed to be the channel, and the market is supposed to touch this part and come back down. But as you can see, the market will do what it wants to do. You just have to be the one to adjust. You see the way short out of the trading channel, the trend channel. He shot out of it and it's just doing whatever it likes here. Yeah, gold. As a beginner trader, I will not advise you to trade gold for now because gold has a very high volatility. Yeah, as you can see, this is a marked up trade. Yeah, we've already marked this up. You remember when I told you about trading in lower time frames? Yeah. So you see, this is a 1 hour. You see how this particular trade played out for us last week, and we're able to go out somewhere here. Yeah, it was a good one. Uh, like as you can see, there is a bigger channel, and it kind of went out of it, and then it's back inside. So in the coming week, I'm recording this on a Sunday. So I think by Monday, which is tomorrow, we'll be looking to take. Uh, let's see. We'll be looking to take this short here. Short means you're trying to sell. We'll be looking to take this short down to this other level. Yeah. So these are like what we'll be looking for. But remember, there's always a risk. So this part is your risk. So if it doesn't play out, you're going to lose. You're going to lose this part here. So that's what trading is. But one of the things that helps a trader is the risk to reward ratio. So you're consistently losing this to make this. Yeah. So I'll just stop for today, and our next couple of videos will hopefully cover different aspects of trading. Uh, thank you.